Today, I reveal my entire $176,000 TFSA portfolio that has outperformed the S&P 500 over the years. Let's do this! Before we start, I'll give you a little bit of background on me. I'm living and working in Vancouver, Canada, one of the most expensive cities in the world. I invest in Canadian dividend-paying stocks and ETFs to generate passive, growing income so I can work less, live more. My wife and I do our finances together. We have 3 accounts through 2 brokerages, Scotia iTrade and Wealthsimple. First, let's see an overview of each account, and then I'll show our combined TFSA portfolio that I manage. Here's my wife's TFSA account in Wealthsimple. This is a relatively new account. Market value is about $6,200 with only 9 holdings. Even Warren Buffett had small beginnings, didn't he? Now, the majority of her TFSA contribution is in her Scotia iTrade account. Her 10 holdings have a market value of about $78,100. She has 6 free trades a year, so I try to keep her transaction costs at 0 each year and utilize DRIP when I dollar cost average. Lastly, here's my TFSA account with Wealthsimple. I like Wealthsimple for one reason, the free trades. It's great to keep fully invested. My account has all 22 holdings of our combined portfolio. Current market value is about $92,500, substantially down from the 2022 highs in February. Now I'm going to reveal each of our 22 holdings, why we have them in our portfolio, and I'll give you some insight on each one. I'll start with my one ETF, VFV. It's Vanguard's non-hedged S&P 500 index ETF. I know this will eventually have to be kept in an RSP account to save on the 15% withholding taxes for its distributions, but it doesn't really bother me at this value. There's also the consideration of buying VOO to lower the MER, which is the underlying holding of this ETF anyway. I just hate playing the currency game as I did in the past, so for now, VFV gives me more US exposure and adds stability to my portfolio. Plus, the 0.09% MER is reasonable. On a side note, I'll take VFV over VSP, the hedged fund, since VFV has outperformed to date. Next, I'll go through each holding according to its size in my portfolio, except for my largest holding. Stick to the end of the video for that one. My second largest holding is Power Corporation of Canada at 8.1% of our portfolio. It really is an international management and holding company that focuses on financial services in North America, Europe, and Asia. It holds a huge stake in Great-West Life, IGM Financial, GBL in Europe, as well as alternative asset investment platforms. They also own a huge stake in Wealthsimple. I love using the products I invest in. As a holding company, their NAV is huge compared to the stock price right now. I'll continue to DRIP as long as they keep growing those dividends as they have for the past 7 years straight. Next, at 7.4% of our portfolio, is Bank of Nova Scotia. I have to say, she is the loser of the banks over the past 5 years in terms of growth, and for that reason, I rotated a lot of cash into her. Bank of Nova Scotia has been paying consistent dividends for over 100 years and growing those for 11 years until the Canadian regulators put that moratorium on dividend increases and buybacks in 2020. Just this month, their distribution increased another 3% after an 11.1% increase at the end of 2021. They are a huge play in South America as well. I like that bet and will continue to DRIP as long as their price per earnings stays low as it has and continues to be the loser of the financial sector. Next is TC Energy Corp at 7% of our portfolio. I love that they have grown their dividends for 21 years at a 7% rate over the last 20. Just recently, they have lowered their expected future dividend growth down to 3 to 5%. This has forced me to put the brakes on DRIP because it breaks the rule of 12 I go by. I'll continue to monitor the price to see when to turn it back on. Next up, we have a mid-cap utility in Capital Power Corp at 6.9% of our portfolio. This is definitely a risky position for us as it is a newer independent energy producer, but one of my faves. I got in because management has done an amazing job at increasing FFO with investment in solar, wind, and storage, as well as their carbon capture project, among other things. They are targeting a 5% dividend growth for the next 4 years, which is below their trailing 5-year DGR at 7%. The stock price has really gone up recently, dropping this below a 5% yield. I'm looking forward to the next quarterly where I expect a 5% dividend raise. Next, we have another financial services company, First National Financial, at 6.9% of our portfolio. I'll have to admit, I added to my holding at the wrong time, dollar cost averaging up too much, only for the stock to drop again, more in line with where I think it should be valued. They are a mid-cap company we have, and the only one in the mortgage finance industry. They've done amazing over the past few years and raised their dividend yet again to keep the streak going. They also gave a 5th consecutive special dividend last year. Recently, they have had some difficulty with the changing market environment. I have strong conviction that their team will continue to grow and capture more of the Canadian mortgage market and grow the dividend at the 7% they have over the past 10 years. I'll be looking to add at the current share price. Next is BCE Inc. at 6.6% of our portfolio. This is a core holding of our turf model. They recently raised their dividend 5.1% and have been growing them for 13 straight years. I love telecoms in Canada as they have a huge impenetrable moat and pricing power to perform well in an inflationary period like we're going through. I wish I doubled down on them during the March crash. Hindsight is 2020, right? I just have to keep an eye on their payout ratio right now, though it is safe from a free cash flow perspective. Next is ENBRIDGE at 5.5% of our portfolio. What dividend growth portfolio doesn't contain ENBRIDGE? The stock price has recently gone up a lot, and the growth prospect has really decreased over the past few years. Their most recent dividend raise was only 3%, as opposed to their 10-year average of 13%. Can you knock a 26-year dividend growth streak though? I won't be adding at the current stock price. Next up is our second utility, ALGONQUIN Power and Utilities Corp, which is our renewable energy play at 5.4% of our portfolio. They have been issuing stock and diluting shareholders over the past few years and growing their debt levels, which has left a bad taste in the mouth of some shareholders. I'm very comfortable with their debt level as a utility stock that has been raising dividends for 11 years straight, and over the past 5 years at a rate of 7.5%. I also like the DRIP discount they give on their shares. As a very diversified and well-managed company I believe in, I'll be dollar cost averaging down even more so below $18. Next is our last oil and gas midstream company, PEMBINA Pipeline Corp at 5.3% of our portfolio. This is a stock I had been contemplating cutting from the portfolio during the crash. They hadn't grown dividends for almost 3 years and have a 5.8% 5-year dividend growth rate. There are rumors of a 0.5 cent to 0.75 cent monthly dividend increase in the works, which may lead me to increase my position slightly. This is the smallest of the 3 pipelines that has recovered well. With what has happened in Europe, I'm fully convinced that gas and oil are here to stay for my lifetime, and I shouldn't divest completely from the industry or sector. Next up is our last utility, FORTIS, at 5% of our portfolio. Another staple in most dividend growth portfolios. It has grown dividends for much longer than I've been alive at 48 years, second most in Canada behind Canadian utilities. Its 20-year dividend growth rate is a healthy 7.7%. It is well diversified and has a stable revenue stream with good, solid, continued growth due to investments. Dividend growth is pegged at only 5% in the coming years, which doesn't excite me at the current stock price. This comes in well below my rule of 12 right now. I'll look to add if it pulls back substantially. Next is a REIT, SmartCentres Real Estate Investment Trust, at 4.8% of our portfolio. This is another staple in our turf portfolio. REITs won't ever fit the rule of 12 I have for myself. They're here for stability, with $11.7 billion in assets. I like SmartCentres because they are anchored by Walmart, and we all know Walmart isn't going anywhere. They had some trouble during the past 2 years. However, they have been slowly increasing their pipeline of projects from shopping centers to city centers. They have some prime properties in major cities. If there's a pullback again, I'll add more. Next is Great-West Lifeco at 4.2% of our portfolio as a solid large cap company. I know, this is a portfolio redundancy as I have ownership through Power Corporation of Canada. I just love how diversified they are for revenue streams, divided between Canada, US, and Europe pretty much equally. They've been steadily growing their dividends for 7 straight years, just like their parent company. Unfortunately, I already owned GWO before I bought into POW, but I just can't seem to find a reason to sell it quite yet, even when it hit its new all-time high. Let me know what you think I should do with this holding. Next is TELUS Corporation at 3.8% of our portfolio. This telecom is the better performing of the two we own. It has done exceptionally well at diversifying its revenue, spinning off TELUS International. They just again raised their dividends and have been for 18 years at 8.7% over the past 10. I like the moat they have and the pricing power. That's one of the benefits of turf stocks after all. I'll be adding to this position in the event of a pullback to get it closer in line with our BCE holding. Next is another large cap insurance company in MANULIFE Financial Corporation at 3.8% of our portfolio. As you can tell, I like financials a lot. They are very diversified with many streams of revenue and have a large presence in Asia. Their share price has struggled since the financial crisis, which doesn't bother me one bit. We're in the accumulation phase of investing. They continue to grow their dividends at a rate of 9.6% over the past 5 years. I'll look to add to this position as the price per earning is well below their historical average, as is their current dividend yield. Maybe I should finally pull the trigger and move my GWO holding here. Next is a small cap asset management company in FIERA Capital at 3.7% of our portfolio. This is by far the riskiest holding in our portfolio. I like their investment platform and how they've been able to continue to grow their revenue over the years. They have a 5-year dividend growth rate of 6.4%. Their assets under management, though, have dropped recently, really hurting the stock price. As has the investment of 3.6 million shares by Natixis IM. Net debt is up 10%, which is worrisome too. I still believe they are capable of maintaining the dividend. Growth in the future seems slim though, but with that yield, I can wait. I'm deciding what to do with them in the near future if the share price drastically recovers. The next few holdings are all rather small. I have either recently divested some or haven't bought in quite some time. Canada National Railway is our only industrial stock at 1.5% of our portfolio. I really should have increased my position during the crash. They fit the rule of 12 I go by, increasing dividends for 26 years straight, with a dividend growth rate of 14.2% over the last 10 years. They are one of 2 big players in the railroad industry in Canada with an impenetrable moat. And you know, I like moats. Good luck creating another large cap railroad company to compete with them. I love their growth prospects as their integration into the US makes for automatic growth as both economies grow in size. Next up is another diversified bank in Toronto Dominion at 1.1% of our portfolio. This should be much larger. However, I trimmed it when the stock price was over 100 and I couldn't see the rationale for it. This goes against my rule of not trimming my winners, but rules are meant to be broken, right? TD is the best run bank in Canada to me and has a huge presence in the US. It has a 5-year DGR of 7.9%. I expect another raise to come at the end of 2022. Next is our last bank in Canadian Imperial Bank of Commerce at 1% of our portfolio. This is another bank that I trimmed during their all-time highs. Some got excited by the 2-for-1 share split. Splits don't excite me. This is the smallest of the original Big 5 banks and is heavy into real estate. This is another reason I decided to trim my holdings here. I feel the Canadian real estate market will be depressed for some time and lead to less mortgage originations and less revenue. They are still a solid dividend grower at 5.4% over the last 5 years. And lastly, my smallest position at 0.5% of our portfolio is GOEASY Ltd. They're in the credit services industry and are a recent addition to our portfolio. I was skeptical of them at first as a high-growth small-cap stock in the financial sector. After the major pullback this year and continued growth, I looked into their business model deeper and was convinced they have a large door of opportunity, given the rising interest rate situation, high inflation, and a big buffer with the leverage they use. I'll look to add more if this continues to drop further. I almost forgot our one closed-end investment fund we have, CANEO EIT Income Fund. I'll admit I should have divested from this a long time ago, and instead I added during the 2020 lows. It is an actively managed fund with a high MER of 2.36%. Our dividend and cost is really high, and we have a big gain on the share price as well. If this weren't in a TSFA, I would have dumped quicker. I'm not an income investor, nor do I plan on it. I like their holdings, diversification, and fund manager. I'll keep this on the back burner and use the distributions to purchase other high conviction stocks. And now for our biggest holding, RioCan Real Estate Investment Trust at 9.7% of our portfolio. I added a lot during the 2020 crash to bring down my cost average, not expecting the distribution to be cut in early 2021. They have $14 billion in assets and a ton of properties under development in the Toronto area that will add to their AFFO. I'll keep adding to this as the NAV is way above current price, and I see them returning to the 12-cent monthly distribution by 2024-2025 in spite of the predicted real estate market downturn. So there you have it, all 22 of our holdings. Thank you so much for watching and ever so gently clicking that like button and subscribing to help out the channel. Until next time, I'm Mr. Financial.